Hi, welcome to Solution In YouTube channel. In today's video we will learn about put options. Meet Alex. Alex has got some savings and he wants to invest in stocks and is looking for a safe way to make profit. One of the ways is investing in stock options. An option is a derivative instrument that gives the holder a right to buy or sell a security at a certain price called a strike price at the expiration date. Remember, an option is a right, not obligation. But why Alex seems to be worried? The reason is that he wants to secure a higher selling price to make a profit, but the prices are falling. In this case, a suitable hedging strategy is using put options to protect his investment. Let's see what the mechanism of put options is. The writer of the put option charges a minor fee called premium for which he commits to buy a particular stock at the strike price of $5 from the holder of the put option. This way the writer is giving the holder of option a right to sell a stock. Remember, the purpose of using the options is to reduce the risk against a small premium. Now let's see what happens if the price of share falls or rises. If the market value of IBM share at option expiry date falls below $5, Alex will exercise the option and the writer has to buy the share from Alex for $5. But if the market value of IBM share increases to $5.50 at the option expiry date, Alex will not exercise the option. Because it is a right, not obligation, Alex will sell IBM share in open market at $5.50. So it's a win-win situation for Alex. If you liked the video, hit the like button. And don't forget to subscribe for more videos.